transactions. So in today's lesson, we are going to continue with the rest of the 11 basic transactions and see if possible we can solve some illustrations thereabout. Okay. So yesterday we were able to go through investment by the owner and acquisition of an asset by a business. So I want to believe you are very okay with the first two transactions that we discussed. If not, please ask any question you want to ask. If there are no questions, let's move to the third basic transaction, which is sale of goods. Sale of goods. So as a business, our aim is to sell or provide some services to make profit. So in this case, we are looking at when the business sells goods. Okay, and here goods, here we are referring to the tangible items the business is selling. So for example, if it's a bookshop, the goods will be the books. If it is a vehicle dealer, the goods will be the vehicle. If it is a grocery shop or a supermarket, the groceries are going to be the goods. Okay. Now look at something here. Before we even read what is on the screen, let's discuss. If business bishop sells goods, okay, bishops can receive money, or bishop may have sold the goods without collecting money. If bishops took money, then that is called cash sales. If bishop did not take money, then that is credit sales. So I want you to acknowledge that when we're referring to sales, we can have the cash sales and the credit sales. The cash sales are those sales that are made for cash or check. And then credit sales are those that are done without taking money. The customer would pay later. Now, let me ask my student. If the business sells goods, remember the goods are stock, and you all remember stock is an asset. So if the business sells the goods, which is part of the stock, a current asset, and gets money, what is happening here? Can you identify the two elements in there? We sold goods and we got cash. Yes, who is ready to tell me? Yes, Richmond. Richmond, go ahead. It's like your volume is down. Can you raise your volume a bit? Good. Okay, you are seeing asset and what? Okay, I don't know why your voice is down like that, but just for the purpose of the others. Richmond says that he's seeing asset, cash, and then asset stock. Can we all see that, or do we all agree? Yes. If the business is selling goods, the business is, giving out stock. So asset stock is going out of the business, and then it's also receiving cash. So another cash, which is another asset, sorry, is also coming into the business. So if we analyze critically, you could see that the stock would decrease and cash would increase. If it is check, then bank would increase. Okay, let me acknowledge our new member, Frank Smith. Smith, you are welcome to the financial accounting class. I don't know if you can hear me. Okay, I think, Frank, you can type in the chat if you can hear me, just so I know you can hear me. Okay, so when we sell goods for cash or check, an asset stock would decrease and asset cash or bank would increase. However, if we sold it on credit means we didn't take the money. The customer will pay later, and for that matter, the customer becomes a debtor to the business. In that case, the stock will still decrease, so asset stock will decrease, but there's going to be increase in another asset, which is debtors. So pay attention to the things that I'm going to read. Sales means the sale of goods or stock in which the business normally deals in. So like I told you, when we say sales, we are referring to exchanging the goods or the product the business deals in. So if I deal in buying and selling of books, then when I sell books, that is sales. If I deal in buying and selling of vehicles, don't be deceived that vehicles are fixed assets. Sometimes they can be current asset, which is the stock that the business is selling. Okay, so the nature of the business determines what sales is. So if I'm a vehicle dealing company and I sell a vehicle, that is sales. Okay. So when you sell the goods, right, we are saying that you can sell it for cash or check, or you can sell it on credit. So note these things here. You can sell it for cash or check, in which case we call it a cash sales. Or you can sell it on credit. On credit means that the customer didn't pay. Now, in both cases, you are selling the goods. So stock is going to decrease. The asset stock is going to decrease. Now, when an asset stock is decreasing, we open the sales account. We open the sales account. And then the corresponding account will be the cash account, or if the transaction was done using check, that will be bank. If it is on credit, then we would have a debtor. So that is what is written here. If it was sold for cash or check, then another asset, cash or bank, increases. But if it was sold on credit, then another asset called a debtor is created. So please, let me do these summaries here so that you understand. We are saying we can have two types of sales, which is cash sales. Cash sales means that you sold the goods and you took cash or check. So in that case, you open your sales account, okay, which is acknowledging the decrease in asset stock. Okay, and then the second account will be the cash account or bank account, depending on whether you took cash or check. If you took check, you refer to bank. Now, this account will show the increase in assets, right? Because the business received money from selling the goods. Any question on this? Good. If it is on credit, okay, so we sold the goods, all right, but we didn't take money, so it's on credit. So if we have credit sales, since we are selling, still we'll open the sales account to show the decrease in stock, decrease in asset stock. And then we also acknowledge the second account. Here, the second account will be the debtor's account, simply because the debtor did not pay, or the customer did not pay, and for that matter, he or she is a debtor. So we open the second account, which will be the debtor's account. If the name of the debtor is given, use that. If the name is not given, the title of the account will be the debtors account, right? So yes, so let me add on here. Good. So we are going to open the debtors account, and then to show an increase asset data. So ladies and gentlemen, the point I'm trying to make is that in accounting, your sale of goods can be on cash basis or credit basis. Whether it is cash or credit, always you open your sales account. That account would record the decrease in the asset stock, because as you are selling, your stock will decrease. For example, if I'm a bookshop business and I have 200 books and I sell 150 of the books out, you see the stock will reduce from 200 to 50. So anytime you sell goods, there's a decrease in the asset stock. Stock here is referring to the goods, right? Now, if I sell the books to the customers, the 150 books, I can take money from them instantly. And that is what we refer to as the cash sales. The money can come in the form of the physical cash, or sometimes I may take check. So if it is cash, you open cash account. If it is check, you open the bank account. What impact or what effect is this going to have on the cash or bank? It is an increment, because as I sell the books to them, if they pay me money, as a business, I'm receiving money, so my money will increase. That is why I'm showing here increase in asset, cash or bank. On the other hand, if I didn't take money, if I didn't collect the money, then those people I sold the books to will become my debtors. Okay, the customers I sold to will become my debtors. Okay, any question before we look at some examples and discuss further? Any question? I don't think so. So let's pick the first illustration. Somebody should read it for me. Smith, it seems your microphone is not working so well. I don't know if you can try to see if we can hear you. Okay, let me get the lady in our midst, Prof. Alexia, to read the first transaction on sales for us.
Example A, sold goods to Kwan for 4,000 Ghana cedis cash on 7 January 2022.
Okay, thank you very much. Thank you very much. So my first question is this a cash sales or a credit sale? Prof. Bishop, today I haven't heard your voice. Is this a cash sale or a credit sale? Prof. Bishop, are you there? Okay. Is it a cash sale or a credit sale?
Is it credit?
Is it a cash sale?
Sir, I think so.
Cash sales. Thank you very much. Cash sales. Because as you read in the transaction, you see that they sold the goods for cash. Okay, so that's cash sales. If it had been check, it is still cash sales, right? Good. So if that is the case, what are the two elements here? I think I'll do this one. The two elements, as we have all seen, is that stock or goods is being sold. So there's going to be a decrease in the goods, which are assets. So there's going to be a decrease in asset. So the asset stock, we don't refer to the goods as goods. We use stock to refer to the goods. So the asset stock will decrease. And since the business is getting cash, another asset cash will increase. And yesterday we did the analysis. And for the benefit of Smith, I think I'll go back to that screen for him, and also to remind ourselves about the principle as propounded by Luca Pacioli. So the double entry principle was designed by Luca Pacioli, and for that matter, Luca Pacioli is the father of accounting, financial accounting. Okay, so Sir Smith, we did this summary yesterday regarding the double entry principle for the 5 elements of accounting. So this is the table for us. Get it straight that anytime you are looking at a transaction which has assets or expenses, then the double entry principle says that when that asset is increasing, you debit. And when the asset is decreasing, you credit. So take note of that. Capital liabilities income, for them, when they increase, we credit, and when they decrease, we debit. So we are going to use this principle to record this transaction, sale of goods. So as we have deduced, we have asset stock, which is decreasing, and we have another asset cash, which is increasing. So what does the principle say? The principle says that when an asset is decreasing, we credit. So in this case, we are going to open an account for the stock. Now pay attention here. The account you open to record the decrease in the stock is not stock account, but it is sales account. So we open sales account to show the decrease in the stock. Okay. And then for the cash, which is increasing, we open the cash account. So asset cash is increasing, and when assets increase from the table, when asset increase, we debit. So it means that in this transaction, we have to debit the cash and then credit the sales account because stock is decreasing. So if you are asked to debit, this is what you do. You go to the left side of the transaction, you put down the date. So the date on the transaction was 7th January 2022. So 7th January 2022. What happened with respect to cash? We made some sales of 1,000 Ghana cedis. So we debit the cash account. Why? Because the asset cash was increasing. That's why we are debiting it. And then we credit the sales account. And I'm saying that this sales account represents the stock account, a decrease in the stock account. So take note of that. So please don't ever open stock account when you see sale of goods. Open sales account. Any question? It seems like I'm the one doing the talking alone, or you people are not talking at all. Let me pause for question. Ask me question, or maybe I'll ask you question myself. The second example would address the issue of selling the goods on credit. But the point that I made to you, the sales account is what is opened when stock is sold. So take note of that. Anytime you see sold goods, or sold something the business is buying and selling, you open the sales account. And that sales account is recording the decrease in the asset stock. Okay. So let's look at the second transaction. Sold goods to Kwame on credit. On credit. So quickly, the first thing is that this is a credit sale of goods to Kwame. So Kwame here is the customer. So Kwame got the goods and didn't pay the business. So Kwame becomes a debtor, right? Good. So since we are selling goods, we have to open the sales account and open this time Kwame's account, who is a debtor. In terms of the analysis, again, the stock is decreasing. So asset stock will decrease, but we are getting a debtor. So, and a debtor is an asset. So a debtor asset will also increase. But in terms of the account, you open the sales account and Kwame's account, who is the debtor. And like I said, when the name of the debtor is given, use the name of the debtor. So in this case, Kwame account. So we are going to debit Kwame. Why? Because the debtor, which is an asset, is increasing. Okay. If I want to cite as an example, business Smith sold goods to Mr. Amwa. Mr. Amwa didn't pay. So Mr. Amwa now owes Business Smith. So if Business Smith is preparing account, he will open Mr. Amwa's account and show that Mr. Amwa is owing the business. Okay. Now, at the time that Mr. Amwa has not bought the goods, the debtors were 0. So if Mr. Amwa now owes the business, it means the debtors balance will increase. So that's why the asset debtor is increasing. And when an asset is increasing, we debit it, and the corresponding credit entry will go into the sales account, right? Because the asset stock is decreasing. Good. If we are okay with the sales, let's move to the purchases quickly. Now, the purchase is the opposite of the sales. Okay. Purchase this time means the business is rather going to buy the goods. The sales is where the business is selling the goods. So purchase means the business is now buying the goods, right? So here again, we can have cash purchases or credit purchases. Cash purchases means that the business bought the goods and paid money. Credit purchases means the business bought the goods and didn't pay. So in that case, the business would see the supplier, the person from whom they bought the goods, as a creditor, which is the opposite of a debtor. So please pay attention and get these terms right. A debtor is somebody or a customer. Let me write these things down so that you can note them. So a debtor is a customer who owes the business. And then a creditor is a supplier who the business owes. So look at the two, otherwise you get confused. So a supplier, which can be an individual or another business, that the business owes. In the business, no rather than a sanko foneka. So they are creditors. And if it's the customers who owe the business, then those are debtors, right? So back onto the purchases, we can have the cash purchases and the credit purchases. Good. Now here again, you could see that there's also another thing involving goods or stock, right? But this time, it is stock coming into the business. So it means that stock is going to increase. So anytime you purchase goods, stock will increase. But I see that when you sell, stock decreases. So you have to look at the two together because they are opposites of each other. Now, when you purchase with cash or check, look at it, the business. So business Amwa, I'm going to buy goods from Melcom. If I pay cash, I'm getting goods from Melcom and I'm also losing cash to Melcom. So I'm increasing my stock, which is an asset. So increase in asset stock, but there's also a decrease in asset cash or bank if I used check. If I didn't pay Melcom, then Melcom as a supplier will become a creditor. And a creditor is a liability in this case. Okay, let me pause for any reactions or questions. Hey, no question. This is my student. Am I confusing you or you already understand? Or because I need to get some reactions from you. Okay. So note again that we can have cash purchases and credit purchases. Bishop, you have a question?
Yes. In this case,
Oh, in fact, Bishop, the voice is not clear. Can you take it again?
say,
Uh-huh.
please,
Yeah.
does it mean that in this case,
Mm-hmm.
we are going to open this account and every question that has this, we are going to debit the purchase account or something else?
Okay, okay. I think I understand your question. Yes, anytime you see purchase of goods, you open purchases account, right? And this time, because you are purchasing the goods, the stock will increase or the goods will increase. And when asset stock is increasing, we debit it. So you are going to debit your purchases. You see, the opposite is when you sell. When we sell, we open sales account and credit it because the asset stock is decreasing. Okay. Now, if you purchase with cash or check will decrease. So you credit them. If it's on credit, you are getting a liability because you didn't pay. You are owing the suppliers. So it's a liability. So you open the creditors or the suppliers account. And note when a liability increase from the table, you credit. So when a liability increase, we are going to credit. Okay, so let's rejoin with the second session. This first session is up and ending soon. So let's rejoin with the second session details and continue from here. I think I'll take more questions there. So see you there.